Most people think high-tech investing tools can beat the market, but history says otherwise. A simple index fund has beaten most experts, most traders, and yes, even most AI systems. But with the rise of AI, we have to ask if following the tech is the best bet for our investments. In this video, we're putting index funds head-to-head with AI bots to see which one really wins. What are index funds? Index funds are about as simple as investing gets. Instead of trying to pick winners, you buy a fund that holds the same stocks as a big market index like the S&P 500 or the NASDAQ 100. By owning a piece of hundreds of companies in one shot, you don't depend on one or two names. That spreads out your risk and means your returns rise and fall with the market as a whole. Over the past half-century, the S&P has returned about 7 to 10% yearly after inflation. That might not sound exciting compared to stories of crypto millionaires, but steady growth like that compounds into serious money. $1,000 invested back in the 1970s would be worth tens of thousands today, even after all the crashes and recessions. The most popular funds that do this are VOO, SPY, and QQQ. They're run by companies like Vanguard and BlackRock, and they're known for charging rock-bottom fees. Fees matter more than people think. If you pay 1% a year, it can drain away nearly half your gains over a lifetime. Index funds often charge as little as 0.03%. That translates to paying 30 cents a year for every $1,000 invested. It's almost nothing, but it makes a massive difference after 20 or 30 years. The money that doesn't go to fees stays in your account and grows on top of itself. What are AI stock pickers? On the other side, we have AI investing tools. These are platforms that use machine learning to sort through mountains of data to find trends or opportunities. They pull from things like company reports, stock charts, economic numbers, news articles, and even social media posts. They promise to see patterns that humans miss. Names you'll see in this space include Magnifi and Trade Ideas. They work more like active traders. Instead of holding everything, they tell you which specific stocks to buy or sell at a given time. Some even automate the trades for you. Performance comparison. Here's a strong argument for going with AI tools. Why settle for the boring average when you can beat the market using cutting-edge technology? But here's the problem with that. Decades of research show that active strategies rarely beat the broad market over the long run. In 2024, about 65% of active large-cap funds underperformed the S&P 500. Stretch the timeline to 10 years, and nearly 90% lost to the index. Think about that. 9 out of 10 professionals who dedicate their lives to this can't keep up with a plain index fund. AI adds some excitement, but it doesn't rewrite the math. Short-term results can be flashy. For example, MarketSense AI 2.0, a new model tested over 2 years, turned in a gain of about 126%, while the index returned around 73% in the same time. Impressive, yes, but that's a tiny sample. When researchers expanded the timeline or the number of stocks, those strong results faded. In wider tests, AI strategies usually fell behind simple index funds. That doesn't mean AI is useless. It just means it's not the magic bullet many hope for. Risk, fees, and accessibility. Let's talk about costs. Index funds are famous for being cheap. ETFs often charge around 0.14%, and some mutual funds cost only 0.05% or less. Compare that with active funds that charge an average of 0.66%. AI platforms usually layer on extra charges like subscription fees or higher management fees. Active funds also tend to carry higher tax costs because of frequent trading. Taxes alone eat up around 1.2% per year in active funds compared to 0.3% for index funds. Add in the higher fees, and the total drag can hit 1 to 1.5% every single year. There's also the accessibility factor. Index funds are available everywhere, from Vanguard to Fidelity to Interactive Brokers. You can buy them in minutes, hold them for decades, and never touch them again. AI tools require more active management. You need to check signals, follow alerts, and sometimes stomach rapid swings. They appeal to people who love tech and want to feel more hands-on, but beginners can find them overwhelming. Which one should you choose? Now let's be clear, index funds aren't sexy. You won't brag at parties about owning a piece of an index. No one will say, wow, you own a share of the whole market. AI tools feel cooler. They sound futuristic. But cool doesn't equal consistent. The numbers show that over decades, steady, boring index funds tend to leave flashy strategies in the dust. That said, not everyone wants the exact same path. If you're young, tech-savvy, and willing to gamble a bit, trying an AI tool with a small part of your money can be fun. The wise move is to keep index funds as your main investment. Let them do the heavy lifting for your long-term growth. If you want to experiment, carve out a small side account for AI tools. That way, if they shine, you get a bonus, and if they flop, your core remains safe. Financial experts still recommend index funds as the foundation for almost every investor, especially beginners. Warren Buffett has said many times that most people are better off in an index fund than trying to outsmart the market. When one of the richest investors in the world trusts the simple option, that should tell us something. It's also worth pointing out the impact on mental health. Constantly checking AI signals or stressing about short-term trades can wear you down. The market moves fast, and if you're glued to your screen every day, it can feel like a roller coaster with no seatbelt. Index investing, on the other hand, frees you from that cycle. You set it, you forget it, and you spend your energy living your life. Financial freedom isn't just about the numbers in your account. It's also about the peace of mind that comes with knowing you're on a steady path. So which side wins? Index funds or AI bots? The honest answer is that it depends on what you want. If your goal is steady wealth building, low fees, and the best odds of long-term success, index funds are the clear winner. If your goal is excitement, risk, and maybe catching a short-term boom, AI can add a spark. Just don't bet your whole future on it. Mixing both can give you balance, with index funds as the solid base and AI tools as a small experimental add-on. If you want to start building with index funds today, check out Interactive Brokers, which I've linked in the description. They're offering up to $1,000 in free stock when you sign up through my link, which is a nice head start. It's a simple way to begin, and you'll thank yourself later when your money starts compounding quietly in the background. So, index funds or AI bots? What have you tried, and what strategy do you think is best for your situation right now? Let me know in the comments below, and don't forget to like and subscribe while you're there.